Right now, as you are watching this, something extraordinary is unfolding across the North American continent. Long freight trains, packed with Canadian grain, are rolling south through the United States, crossing border checkpoints, cutting through the American heartland, passing mile after mile of farmland where many American farmers are struggling to survive. These trains move quietly but relentlessly, steel wheels humming across thousands of miles of track. And here is the part that should make every American stop and think. Those trains are not stopping in the United States. They are not unloading at American export terminals. They are not delivering grain to American buyers. They are simply passing through, heading all the way to Mexico, bypassing the American grain export system entirely. For a country that once dominated the global agricultural marketplace, that reality should feel almost surreal. The United States built its economic power in part on the strength of its agricultural exports. For decades, American grain fed nations across the world. Corn from the Midwest, soybeans from the plains, wheat from vast American farms, all moved through ports and rail lines that formed the backbone of global food supply. But now something is changing, and it is changing faster than many policymakers in Washington seem willing to acknowledge. This is not speculation. It is not political exaggeration. It is not a dramatic theory invented for headlines. This is documented, measurable, real-world economic change unfolding right now in 2026. And the consequences could reshape North American trade for decades. To understand what is happening, you have to go back to a moment that most Americans barely noticed when it occurred. In 2023, a massive shift took place in the railroad industry. Canadian Pacific Railway completed a historic merger with Kansas City Southern. The deal was worth roughly $27 billion, and it created an entirely new rail company called Canadian Pacific Kansas City, known simply as CPKC. At first glance, it sounded like just another corporate merger. But in reality, it created something unprecedented in modern North American transportation. For the first time ever, a single railroad company controlled a continuous rail network connecting Canada, the United States, and Mexico. Roughly 20,000 miles of track suddenly formed one unified transportation corridor, stretching from the Canadian ports of Vancouver and Montreal all the way south to the Mexican Pacific port of Lázaro Cárdenas. Think about that geography for a moment. Grain grown in the fields of Saskatchewan could now move on one uninterrupted rail line through the American Midwest and straight into Mexico without ever switching rail companies. No delays at interchange points. No costly transfers between different rail networks. One seamless supply chain linking three countries. When the merger was proposed, the idea sounded promising for everyone involved. Advocates spoke about stronger continental trade, more efficient supply chains, and economic growth that would benefit businesses in all three countries. On paper, it looked like a win for North America as a whole. But then, politics intervened. In early 2025, the trade environment shifted dramatically. The Trump administration introduced sweeping tariffs under the International Emergency Economic Powers Act, imposing duties of roughly 25% on many imports from Canada and Mexico. What had once been a predictable trade relationship suddenly became uncertain. And in the world of international grain markets, uncertainty is poison. Grain buyers operate on razor-thin margins and long-term contracts. They depend on reliable shipping schedules, stable prices, and predictable government policies. When tariffs appear suddenly or political disputes threaten supply chains, buyers start searching for alternatives immediately. That is exactly what began to happen. Canadian exporters, looking at the growing tension in trade policy, started reconsidering their dependence on the American market. And CPKC's leadership saw an opportunity. The company's CEO, Keith Creel, began presenting the railroad as something far more powerful than a simple transportation company. He described it as a continental land bridge. The concept was surprisingly simple. Canadian goods could travel through the United States on sealed railcars under bonded transit rules, meaning they technically never entered the American commercial system. The shipments would move across U.S. territory without being subject to American tariffs or customs processing, continuing directly to Mexico where they would be sold to buyers there. This system is perfectly legal under long-standing international freight regulations. Goods transported under bond remain sealed and monitored as they cross a third country, ensuring they reach their final destination without entering the intermediate market. And because CPKC operated a continuous rail line, it could move these shipments faster than any competing route. The significance of this arrangement became clear in late March of 2025. A train carrying Canadian oats departed from a grain facility near Regina in Saskatchewan. For decades, shipments like this typically headed to American buyers, because the United States has long imported large quantities of Canadian oats every year. But this train did not stop in the United States. Instead, it rolled straight through the American Midwest, crossed the southern border, and delivered its cargo directly to Mexico. It was the first time in history that a single-line rail shipment carried Canadian oats directly to Mexican buyers. To many observers, it looked like a small logistical experiment. In reality, it was a signal that the traditional patterns of North American grain trade were beginning to change. And once the first shipment proved successful, the momentum started to build. CPKC began transporting more Canadian agricultural products south, while simultaneously moving Mexican goods north. Fresh produce grown in Mexico began traveling by rail to Canadian grocery chains that had previously sourced much of their produce from American farms. One of Canada's largest grocery companies, Loblaw, openly stated that it would start seeking alternative suppliers for products it had historically purchased from the United States. Mexico quickly emerged as one of the most attractive options. For Mexican exporters facing American tariffs, selling directly to Canada offered an appealing new market. And for Canadian retailers hoping to avoid supply disruptions, diversifying away from American imports made strategic sense. While these new trade patterns were forming, Canada's rail infrastructure was expanding at remarkable speed. Canadian National Railway, another major rail company, committed to transporting between 27 and 29 million metric tons of grain during the 2025-2026 crop year. Meanwhile, the broader Western Canadian grain movement was projected to reach approximately 31 million metric tons, surpassing previous records. CPKC itself announced more than 500 million Canadian dollars in infrastructure investments. The company began purchasing new high-capacity grain rail cars while adding 100 modern Tier 4 diesel-electric locomotives to its fleet in a single year. One of the most important developments occurred in December 2024 with the completion of a second international railway bridge connecting Laredo in Texas with Nuevo Laredo in Mexico. The new structure, named the Patrick J. Ottensmeyer International Railway Bridge, eliminated a critical bottleneck that had slowed cross-border freight traffic for years. The impact of that single project cannot be overstated. With two bridges operating instead of one, rail traffic between the United States and Mexico suddenly became faster and far more efficient. But infrastructure alone was not enough. Governments also began modernizing the administrative side of trade. In November 2025, Canada introduced a new electronic phytosanitary certification system for grain exports to Mexico. While that might sound like a minor bureaucratic change, it streamlined the entire export process and reduced the risk of fraud or paperwork delays. For international buyers, efficiency matters. When shipments arrive faster and with fewer complications, suppliers become more attractive. The result is that Canadian grain is increasingly competitive in markets where American producers once held overwhelming advantages. Lower transportation costs and smoother export procedures mean Canadian shipments can often arrive at their destinations cheaper than American equivalents. At the same time, the United States has been experiencing a troubling shift in its agricultural trade balance. For decades, America enjoyed a strong agricultural trade surplus, exporting more food than it imported. But that pattern has begun to reverse. In 2023, the United States recorded an agricultural trade deficit of about $16.7 billion. By 2024, the deficit had nearly doubled to over $31 billion. Government projections suggested that the gap could approach $50 billion in 2025, the largest agricultural deficit in American history. The numbers become even more striking when looking at specific commodities. American soybean exports, once a cornerstone of global grain trade, have declined significantly. The United States now accounts for a much smaller share of the global soybean market than it did a decade ago. Much of that lost demand has shifted to South America. Brazil and Argentina have dramatically expanded their agricultural production and invested heavily in transportation infrastructure to move crops to international markets. China, once the largest buyer of American soybeans, has increasingly turned toward South American suppliers as trade tensions complicated purchases from the United States. Corn exports have also faced growing competition as other countries increase their output and capture emerging markets across Southeast Asia and Africa. For American farmers, these global changes have created enormous pressure. Since the late 1990s, more than 300,000 family farms have disappeared. Larger agribusiness operations now dominate a growing share of production, while smaller farms struggle to survive rising costs and shrinking margins. The cost of producing crops continues to climb. Estimates suggest that planting a single acre of corn could cost more than $900 in 2026, while market prices often fail to cover those expenses. Agricultural organizations have repeatedly warned that rural communities are entering a severe economic crisis. And just as these pressures intensified, another dramatic event shook the entire trade policy landscape. In February 2026, the United States Supreme Court issued a major ruling regarding presidential tariff authority. In a 6-3 decision, the court concluded that the International Emergency Economic Powers Act did not grant the president authority to impose tariffs on foreign imports. The ruling effectively invalidated several tariff programs that had been central to the administration's trade strategy. Within hours, the administration responded by imposing new tariffs under a different statute, Section 122 of the Trade Act of 1974. But those tariffs come with strict limitations and can only remain in place temporarily without congressional approval. Legal challenges quickly followed, and multiple states filed lawsuits questioning whether the conditions required for those tariffs actually exist. Regardless of how those legal battles unfold, the broader reality remains unchanged. International partners have already begun adjusting their trade relationships. Canada and Mexico have invested heavily in new infrastructure, transportation systems, and commercial partnerships designed to reduce their reliance on the American market. Once these investments are made, they rarely disappear overnight. Rail corridors have been built. New locomotives are already hauling freight. Digital certification systems are in operation. Contracts between exporters and buyers are being signed. Every shipment of grain traveling directly from Canada to Mexico represents another step toward a more diversified North American trade system, one where the United States no longer sits automatically at the center. And that raises a difficult but necessary question. Has the strategy behind the recent trade conflicts actually strengthened American economic power, or has it accelerated the shift of global markets toward new competitors? Supporters of aggressive tariff policies argue that they protect domestic industries and reduce unfair trade practices. Critics counter that unpredictable trade wars damage alliances and push partners to seek alternatives. What we can say with certainty is that the global agricultural marketplace is changing quickly. Brazil, Argentina, Russia, Ukraine, Australia, and several other exporters are expanding production and capturing growing demand. Competition is intensifying, and every exporting nation is fighting for its share of global markets. In that environment, stability and cooperation often matter just as much as production capacity. Farmers, railroads, and international buyers cannot afford to wait while governments debate policy. They make decisions based on practical realities, shipping costs, delivery reliability, and long-term partnerships. When those factors change, supply chains adapt, and once those new supply chains become established, reversing them can be incredibly difficult. Right now, North America is witnessing the early stages of that transformation. The trains moving quietly across the continent today may represent the first signs of a much larger shift in global trade. Whether the United States adapts to this new landscape or continues losing ground will shape the future of American agriculture for generations. And that, ultimately, is the question facing policymakers, farmers, and voters alike. The reality is stark. The United States has spent decades building a global reputation as the dominant agricultural superpower, but in the span of just a few years, that position has been challenged like never before. The CPKC rail corridor, the investments in Mexico-Canada trade, and the rapid diversification by Canada and Mexico are all structural changes. These aren't temporary shifts that can be reversed with a single presidential decree or a court ruling. They are baked into the physical and legal infrastructure of North American trade. Every mile of track laid, every new locomotive purchased, every bonded shipment that bypasses US ports, it all chips away at the leverage America once took for granted. Meanwhile, American farmers are caught in the crossfire. For generations, Family farms were the backbone of rural communities. Today, these same farmers face shrinking margins, rising input costs, and an ever-growing competitive disadvantage. Corn costs are rising above market value, soybean exports are declining, and the disappearing American share of the global grain market has real consequences for the men and women who feed this country. And it's not just an economic issue, it's a social one. Entire communities are shrinking, schools closing, and the social fabric of rural America is fraying. This isn't a crisis waiting to happen. It's happening right now. At the same time, U.S. trade policy continues to stumble. Tariffs imposed without congressional authority, legal challenges, and public backlash have all undermined confidence in America as a reliable trading partner. Canada and Mexico are no longer waiting for policy to stabilize, they're building alternatives. They are connecting markets, streamlining logistics, and securing deals that bypass American involvement. When global buyers look at reliability, speed, and cost, America is increasingly seen as unpredictable. And in international markets, unpredictability costs market share, sometimes permanently. The bigger picture is even more daunting. South American producers are scaling rapidly, Black Sea exporters are expanding, and global competition is intensifying. The United States can no longer rely on historical dominance. If America wants to remain a major player in the global grain market, it must adapt, investing in efficiency, strengthening international relationships, and prioritizing predictable trade policies over aggressive posturing. Otherwise, the trend lines are clear. The US will continue losing ground to competitors who combine strategic planning with infrastructure investments. For everyday Americans, the implications are immediate. Farmers face income instability, rural communities face depopulation, and consumers may face higher prices as trade inefficiencies ripple through the system. But there is a path forward. Strategic, well-executed policy, combined with investment in transportation, technology, and export support, could help reverse some of these trends. It requires political leadership willing to balance assertiveness with pragmatism, partnerships with global buyers, and a commitment to building resilient systems rather than relying on short-term threats or tariffs. As you watch these trains roll across the continent today, think about the larger story they tell. They are not just carriers of grain, they are carriers of a new economic order, a restructured trade network that signals how quickly global leverage can shift. The United States still has incredible resources, incredible talent, and the potential to regain competitive advantage. But regaining that position will require acknowledging reality, adjusting strategy, and acting decisively. Because every day that these shipments bypass US ports, every ton of grain that reaches Mexico without American oversight, the clock ticks on lost opportunity. So ask yourself, and ask your leaders, what is the plan to secure America's place in the global agricultural landscape? How will rural communities survive and thrive? How will the US respond to infrastructure that effectively locks out American influence in continental trade? These are not theoretical questions, they are questions of immediate consequence. The time to act is now, before these structural changes solidify further and the opportunities lost become irreversible. Because make no mistake, the trains keep moving, the corridors keep growing, and the world keeps adapting. The question is whether America adapts with it or continues to watch its leverage slip away.